Halliburton's Q2 2026 earnings just dropped, and we are looking at a solid top-line beat here. They posted $5.7 billion in revenue, which is up from $5.4 billion in Q1, edging out most consensus estimates. Net income hit $534 million, coming in at 64 cents per diluted share.
Right. And the market reaction has actually been mostly positive in early trading, pushing the stock up slightly, though, you can see some clear hesitation from institutional buyers.
Yeah, definitely. There are a few specific regional headwinds we need to dig into. But as for guidance, CEO Jeff Miller is sounding pretty confident. He sees this quarter as basically setting the stage for long-term margin expansion and revenue growth.
Well, the street was definitely looking for margin resilience today, and Halliburton largely delivered. I mean, they posted a 14% operating margin for the quarter.
Which is huge.
Yeah, and if you strip out a few one-off corporate items, you get an adjusted operating margin of 12%. For an incredibly capital-intensive industry, where you are moving massive amounts of earth and steel, maintaining double-digit margins is the whole game.
It really is. It's not just about defending that 12% either. They are actively trying to widen it. But to figure out if that's actually realistic for you to expect, we need to look at where this $5.7 billion is coming from geographically. Because the regional splits highlight a pretty severe disconnect in the global economy right now.
Yeah, let's start with the foundation. The North American market brought in $2.3 billion. That is a 7% increase sequentially from Q1. Miller called out a clear recovery there, specifically pointing to higher stimulation activity in U.S. land ops.
Let's actually pause on that term real quick because it gets thrown around a lot. When they say higher stimulation activity, we are primarily talking about hydraulic fracturing.
So it's like, yeah.
Like pumping specialized fluids and sand down a wellbore under extreme pressure to crack the rock.
Exactly. It's heavy, grueling, equipment-intensive work. So when stimulation activity is up, it means operators are actively trying to increase the yield of existing wells or, bringing new ones online. They also highlighted increased fluids activity in the Gulf of Mexico.
Okay, so supplying the highly engineered drilling muds for deepwater rigs.
Right, so the domestic picture is looking highly active.
Got it. But the international numbers are where the narrative totally splinters. So international revenue hit $3.4 billion, which is up 5% overall. But if you look under the hood, Europe and Africa saw this massive 19% revenue spike in a single quarter, hitting $1 billion.
Yeah, that was a huge jump.
Right. But then contrast that with the Middle East and Asia, which historically just prints money for oilfield services. That region actually shrank by 2%, landing at $1.3 billion. It's like Europe stepped on the gas while the Middle East hit a sudden speed bump. What is driving that divergence?
If we connect this to the bigger picture, the Europe and Africa surge is driven by aggressive development in just a few key areas. Like, the report outlines a major uptick across the North Sea, but more importantly, they highlight significant well construction campaigns in Namibia and Egypt.
Oh.
Yeah, plus higher sales for completion tools in the Mediterranean and the Ivory Coast.
Yeah.
So we're seeing international operators rush to develop these specific African and Mediterranean offshore resources.
So they are throwing capital at new offshore developments. But the Middle East shrinking by 2% seems, entirely counterintuitive, especially since they noted higher well construction in Saudi Arabia and the UAE during this exact same period.
They did, but it just wasn't enough to plug the hole created by geopolitical friction. The report explicitly attributes the 2% dip to lower activity in Kuwait, Iraq, and Qatar. And they don't mince words. It's a direct result of ongoing geopolitical conflicts stretching across the Middle East.
Man, this is where macroeconomics physically collides with the balance sheet. You can secure the contract, you can have the equipment staged, but if a region becomes a conflict zone, what actually happens to the revenue?
Well, the revenue gets deferred, but the costs often don't. That's the problem. When a region becomes unstable, project timelines immediately stretch out, supply chains freeze. You have highly paid expatriate crews and millions of dollars of heavy equipment just sitting idle, either because it isn't safe to move them or because local governments pause the permits.
And Halliburton still has to absorb all those fixed costs.
Exactly. But the operators aren't paying them for active drilling days. so it immediately compresses margins for that specific region.
Which perfectly illustrates why a company of this size has to maintain geographic diversification, because Latin America also stepped up, growing 3%, which kind of helps absorb the shock of those Middle Eastern delays. But let's move from the geography down to the actual operations.
Yep.
So Halliburton splits its business into two primary segments. You've got completion and production and drilling and evaluation.
Right, and completion and production is the larger of the two. That brought in $3.2 billion this quarter, up 6%. This perfectly aligns with what we just discussed, increased stimulation activity in the Western Hemisphere. They also noted improved well intervention in Asia.
And for those tracking the mechanics here, well, intervention basically means going into an already producing well to perform maintenance or, fix an issue to boost the production rate. Because it's almost always cheaper to squeeze more out of an existing well than to drill a brand new one.
Exactly. And then you have the drilling and evaluation segment, which generated $2.5 billion, up 5% sequentially. They attribute this to an increase in drilling-related services and wireline activity globally.
Wireline activity being lowering specialized cables down into the wellbore to attach sensors or explosive charges. Very technical, very physical services. But looking at the financials for that D&E segment, there is a glaring discrepancy I want to challenge you on.
All right, hit me.
So revenue for drilling and evaluation went up 5%. That's an additional $126 million in top-line growth compared to Q1. But the operating income, the actual profit generated by that segment, shrank by 4%. It dropped $13 million. How does a segment bring in $126 million more in revenue but actually lose ground on profitability? Are their physical operations suddenly running less efficiently?
It is a phenomenal question. And the answer is actually buried in a footnote regarding their product mix. The report attributes this drop in operating income specifically to a, quote, seasonal roll-off of software sales.
Wait, software sales? We're talking about an oilfield services company that builds drill bits and pumps cement. How much can software possibly move the needle on a $2.5 billion segment?
It moves the needle dramatically, mostly because of the fundamental nature of profit margins. Think about the economics. When Halliburton increases its wireline activity, they're generating substantial revenue. But the cost of goods sold is massive.
Oh, sure. You're paying specialized crews, burning diesel fuel.
Right, maintaining heavy machinery. The profit margin on those physical services is relatively tight. Now look at their software division. They develop highly specialized proprietary software for subsurface modeling and reservoir simulation.
Okay, I see where this is going.
The initial R&D to build that software is huge. But once it's built, the marginal cost of selling an additional cloud subscription to a national oil company is essentially zero. Software revenue is practically pure profit.
Wow. Okay, I see the dynamic. So during this quarter, their physical, lower margin services ramped up globally, driving total revenue higher. But simultaneously, their high margin software renewals dipped because of seasonal contracting cycles.
Exactly.
And the lack of that pure profit software revenue basically dragged down the total operating income for the entire segment, even though they were busier in the field.
Precisely. It proves that for modern energy services, the mix of what you sell is just as critical as the volume. And this software dynamic actually points to the most aggressive strategic pivot in this entire earnings report. Halliburton is actively blurring the line between heavy industry and Silicon Valley.
Yeah, here's where it gets really interesting. You look at the operational highlights, and they literally read like a tech company's press release. In May, they hosted their 2026 Technology Showcase in Houston. They announced the acquisition of Informatica AS, which is a Norwegian cloud-native app company.
Right.
And they finalized a strategic collaboration with Shape Digital to deploy applied AI.
What's fascinating here is that this isn't just corporate buzzword compliance. Every industrial company wants to say they use AI to inflate their valuation. But Halliburton is demonstrating exactly how this digital layer fundamentally changes the physics and economics of drilling.
Let's make this tangible for the listener. How does a cloud-native app or a predictive AI model actually change what happens on a deep water rig?
Well, look at the physical hardware they launched in tandem with this software. They rolled out the OSTMZ Sand Control System Optimized Single-Trip Multi-Zone. In complex offshore wells, operators have to manage different geological zones. Historically, this meant multiple trips.
Which means pulling the tools all the way out.
Yeah. You lower a massive string of tools to treat one zone, pull the entire string miles back up to the surface, reconfigure it, and send it back down for the next zone.
And a single trip in a deep water environment can take days, right?
Hmm.
Costing millions of dollars in rig time alone.
Exactly. It's insanely expensive. But the OSTMZ system allows them to treat multiple zones in a single trip without pulling the deployment tool out of the well. Now, pair that highly efficient physical hardware with their new Xaminer deep testing logging service, which uses advanced sensors to map reservoir boundaries in real time.
Okay, so they're collecting massive amounts of high-fidelity data while operating the hardware more efficiently.
Right. And then you feed all that sensor data directly into the cloud-native software they just acquired from Informatica. The AI analyzes the data in real time, predicts equipment wear, optimizes the pumping schedules, and updates the geological model instantly.
It just completely removes the human latency.
Yes, you are reducing rig time, preventing catastrophic equipment failures through predictive maintenance, and drastically lowering the total cost of ownership for the oil company.
They're essentially digitizing the entire nervous system of the well site. And the mega contracts they announced in Q2 prove that the world's largest energy producers are completely buying into this model.
Oh, the scale of the contract wins this quarter is staggering.
Yeah, let's run through them. Saudi Aramco awarded Halliburton lump sum turnkey contracts for multiple onshore fields covering roughly 285 new wells.
Hmm.
Over in South America, Total Energies awarded them integrated well construction contracts for a deepwater development offshore Suriname.
And in Iraq, the Basra Oil Company brought them in for a major EPCM contract for the Bin Umar and Sinbad fields.
EPCM standing for Engineering, Procurement, and Construction Management, meaning Halliburton isn't just showing up to do a specific job, they are managing the entire overarching project infrastructure. And if you look at all those global mega contracts, the operative word they all share is integrated.
Which is a huge shift. Traditionally, this industry was highly fragmented. An operator like Total Energies might hire one service company to drill the hole, a different company to handle cementing, and a third company for logging software.
Like hiring a bunch of different subcontractors to build a custom house, but none of them are allowed to talk to the architect.
Exactly. The inefficiencies were massive.
So Halliburton is selling themselves as both the architect and the exclusive general contractor now.
Yes. The report specifically notes that for the Iraq contract, they are deploying their landmark digital portfolio. They are embedding their proprietary software right into the national oil company's daily operations.
But I want to push back on that from the operator's perspective. If you are Saudi Aramco, aren't you terrified of vendor lock-in? Like if you hand the keys to your entire digital and physical infrastructure over to Halliburton, you lose all your leverage to negotiate pricing on individual services.
It's a massive risk for the operator, absolutely. But the efficiency gains currently outweigh the fear of lock-in. Having a single, unified data environment from the drill bit at the bottom of the ocean all the way to the cloud server saves them hundreds of millions of dollars in operational downtime.
And from Halliburton's perspective, the stickiness is incredible. Once Total Energies are relying on your proprietary cloud platform to run the logistics for a multi-billion-dollar deepwater development, they are not going to rip out your software just to get a 5% discount on drilling mud from someone else.
Exactly. It creates a nearly unshakable moat around that revenue stream. Which brings us directly to how management is handling the capital generated by these integrated contracts. Cash flow tells the unvarnished truth about operational health.
Right. Let's look at the cash flow. For Q2, the cash generation is really robust. Halliburton posted $824 million in operating cash flow and $668 million in free cash flow. Management is also aggressively returning capital to shareholders, executing roughly $200 million in stock repurchases, and maintaining a dividend of 17 cents per share.
It totally backs up Jeff Miller's commentary on capital discipline. They are funding cloud-native acquisitions, scaling up to manage 285 well turnkey contracts, and still generating enough excess cash to buy back their own equity.
But, when you look at the granular line items on the income statement, there are two specific anomalies that require some translation. First, they reported a pre-tax credit of $95 million classified under impairments and other credits. Normally, an impairment is a write-down, a loss of value on an asset. So why is this a positive $95 million credit?
This raises an important question about how companies report one-off events. When you dig into the footnotes, you see this is a consolidation of several corporate events, not operations revenue. The bulk of it comes from a $54 million gain related to changes in their ownership interest of an equity investment. Basically, a company they own a stake in went up in value.
Oh, okay.
They also recognized a $48 million credit primarily from a government refund recovery.
But those two add up to more than 95 million.
Right, because those gains were partially offset by a $17 million loss they realized when they sold off a portion of their chemical business back in April. So when you net the equity gains, the refund, and the divestiture loss, you arrive at that $95 million positive credit. And since these are non-recurring, management excludes them from the adjusted operating margin.
Okay, that makes total sense. The second anomaly is a $46 million expense getting its own dedicated line item, labeled simply as SAP S/4 migration. SAP is a massive enterprise resource planning software used for internal corporate finance. Why is an IT software upgrade being singled out on the income statement of an oil field services giant?
Because of the sheer scale of the expense. If you look at the 6-month view, they have spent $88 million solely on this SAP upgrade. By breaking it out, management is signaling to investors that this is a massive, temporary capital expenditure, not a permanent increase in daily operating expenses.
It also highlights a pretty fascinating parallel. We spent the last 10 minutes discussing how Halliburton is selling cloud-native efficiency to their clients, but to actually deliver on that, they have to modernize their own internal architecture. They're spending nearly $100 million in half a year just to drag a century-old industrial giant's internal nervous system into the modern digital era.
You cannot sell seamless cloud logistics to Saudi Aramco if your own internal procurement software is a fragmented mess. The external tech pivot requires an equally expensive internal tech pivot.
So what does this all mean? To synthesize the quarter for investors, Halliburton is currently weathering severe conflict-driven project delays in the Middle East by capturing aggressive offshore growth in Europe and Africa while riding a steady recovery in North American stimulation activity.
Right. And underneath those geographic shifts, they are executing a fundamental transition in their business model, moving away from fragmented commodity-style physical services and towards fully integrated mega contracts, heavily insulated by proprietary software and predictive AI.
They beat consensus on the top and bottom lines. They are defending a 14% operating margin, and their cash flow easily supports aggressive share buybacks. But taking a step back from the Q2 numbers, this tech pivot leaves us with a much larger structural question about the future of this industry.
Where does this level of integration ultimately lead?
Exactly. Halliburton is developing cloud-native applications, deploying automated robotics, and utilizing AI to reduce the need for physical human labor on the rig. They are turning the well site into a massive data center. If their proprietary software becomes the indispensable operating system for global energy infrastructure, at what point does a company like Halliburton stop being an oil field services peer and start looking like a prime acquisition target for a massive tech giant?
I mean, if a tech titan decides they want a monopoly on global, industrial, and geological data, acquiring the company that built the actual nervous system for the energy grid might be the fastest way to get it.
It fundamentally changes how you have to value a company that most people still associate strictly with mud and steel. That wraps up our analysis of Halliburton's Q2 earnings. If you want to keep up with this kind of institutional level breakdown, make sure to follow the show. We will be back tomorrow with daily earnings coverage, unpacking the next big report.